If you are looking to buy that beach home and you're thinking, can I write it off my taxes as a business use? The question that you should be really asking is not, can I write it off, but how can I write it off? In this video, that is exactly what we're going to talk about. Is it how can you write off your personal beach house, condo by the ocean, overlooking the ocean, a ski cabin, whatever that may be? How can you write it off as a business expense and get 100% tax deduction? Hey, and welcome to my YouTube channel. My name is Boris Musheyev. I'm a CPA and a tax strategist. I'm here to tell you, if you're making $1 million or more in your business, then you can pay less in taxes by $100,000 or even more instead of giving it to the IRS by doing tax planning strategies and really working with a tax advisor. I have a training how you can save hundreds of thousands of dollars on taxes every year. Below this video, check it out, and I'll see you on the other side. Alright, welcome back to this video, and let's talk about how can you make your beach home a tax deduction, which is 100%. Before we continue, we have to understand rules. Now, here's the thing. Obviously, if you buy a personal beach home, then it's a personal expense. It is not a tax deduction. The question really becomes, how do we make it a tax deduction? So if you follow IRS guidelines and actually this personal purchase that you had, if you convert it or designate it as an entertainment facility for your employees, because it is now an entertainment facility for your employees, it now becomes 100% tax deductible. But there are rules that you have to follow. These rules are simple, and that is what we're going to define in this video. All right, first of all, I want to make sure that we understand the terminology. Now, I feel like I'm a college professor here, but I think for the purpose of this video, it's very, very important. And I want to make a huge disclaimer. This is not the video that you watch and you go ahead and implement this. You need a tax advisor that you're going to do this. Now, this is for educational purposes only, so that you, the profitable business owner, can know, wow, I can do this. And how do I do this? And you need a tax advisor. So if you've got a tax preparer, you don't have an accountant that you work with and strategize on a consistent basis, then please do not implement this strategy on your own. All right, let's get the terminology in. I'm going to refer to this. This is my own terminology, okay? IRS defines this as different terms, but this is for this video. We're going to have executives and we're going to have regular employees. We need to know the difference between both of these in order to understand how to use this tax strategy. So the IRS says, look, if you want to designate your beach home as a entertainment facility for your employees, then your regular employees have to benefit from it more than your execs, all right, executives. And again, we're using this terminology just on this video. Now, who are considered executives? So for the purposes of this strategy, IRS says you are considered an executive if, number one, you are an owner. Okay, again, these are not the people that cannot use it. They just have to use it less than the regular employees. And we're going to talk about the use test and how that works in a second. So the owner is considered the executive. All the immediate family members, actually, I'm not even sure if grandchildren considered immediate. I guess they are, all right? So it's basically your spouse, your children, grandchildren, grandparents, whatever that is. So they're considered executives. They may not work for you in the business. They may have nothing to do with you in your business, but because they're related to you, they are considered executives. The second executives are anybody that owns 10% or more of the business. They are in this bucket right here. And we've got, looking down from my notes, let's see, and also anybody that is making $135,000 or more, they are considered executive. So we've got owners, family of the owner members, $135,000 and plus salary, and more than 10% owners. They're all executives. Everybody else that's left over are regular employees. So we've got that definition. Now, IRS says, look, if you want to designate this as a entertainment facility, then the regular employees have to use it more than the executives. And the rule has to be 51% of use versus 49% of use. So let's do a quick example. We have 365 days in a year. Okay, you're paying expenses for this facility for the entire 365 days. Now, your employees, regular employees, use this facility for 50 days out of the year. You, on the other hand, use it for 40 days out of the year. So altogether, that's 90 days. So IRS says your regular employees use it more than the executives. All the expenses for the entire 365 days becomes a tax deduction. Wow, what an amazing tax strategy. More to say about it, and how can you reimburse yourself? How can you structure everything right after this break? Hey, thank you so much for watching my YouTube video. Just a quick commercial break. If you like what you see, please like the video. As a matter of fact, share it on your YouTube so that you can help other business owners to save money on taxes. I would also appreciate it very much if you subscribe to my video. If you like, share, or subscribe, it really helps me with YouTube algorithm, where YouTube will really push this video to other business owners and they can learn how to save money on taxes using simple tax strategies that I teach with my whiteboard strategy. Thank you so much, and let's get back to the video. Cool, welcome back after this break. If you are new to my channel and love this tax strategy, please let me know in the comments. Be like, Boris, this is amazing so far. Subscribe to my channel, or if you're new, just help me help the algorithm get it out to more business owners. Okay, cool. Now let's talk about how can you structure this. So first of all, the best recommended thing to do, at least what I recommend my clients, is that first of all, you've got your business. Let's say it's an S corporation, and now you want to buy this beach home. The question becomes, Boris, do I need to buy a beach home under this S corp? No, don't do that. Instead, buy it under your personal name and then designate it as an entertainment facility for your employees. Then, under the rules of the accountable plan, so I should have a video below in the description what is an accountable plan, you can reimburse yourself for the use of this facility. So we've got your business that is making money, you've got employees, and a lot of great things are happening. Then you've got this beach home that you purchased, you designated it as an entertainment facility for your employees, you meet the 51-49% rule, and you pay for all of these expenses personally. So not from the business, personally, whatever it is, property taxes, mortgage insurance, and whatever that may be, okay? You're paying for all of that. Now the business is going to reimburse you, the owner, tax-free. Business is going to get a deduction. You do not pick it up as an income. You have this beautiful beach home that you're writing off your taxes. Pretty cool, okay? So make sure you follow these rules. But again, I cannot stress enough how much you need a tax advisor. Don't do this on your own. Don't do this with an accountant that is incompetent, doesn't know how to do this, never heard of this, or tells you it's a red flag. Just, tell them to look up the laws. The last thing I wanted to talk to you about here is proof of use. You've got to prove to the IRS that you've used it. What if there is an audit? By the way, is this something that's going to trigger an audit? No. An audit can be triggered by many things or can be a random audit. This is just a reimbursement to you. You might be asking, Boris, how do I report that reimbursement? Employee benefits, right? It could go on the employee benefits section of your tax return. Now, proof of use. You have to keep a log. Make sure you keep a log that employees are signing in and signing out that they're using this facility, and that, remember, the executives versus regular employees should be using it less than the executive, and that is what your log is going to show. Now, there has been some court cases around this, and the IRS said, no, you've got to meet the use test, because there was a court case, I don't remember which one exactly it was, but they talked about the owner was deducting it, but he was using it more, right? The executives were using it more than the regular employees, but they said, hey, it's not our fault that the employees didn't use it so much. It was available for their use. IRS says, don't play games. IRS says, don't play games with me. If you follow these rules, we'll let you make it 100% tax deduction. But if you don't follow these rules, don't get cute with us. All right, I hope you enjoyed this video. If you're new to my channel, go ahead and subscribe. There is a video training below for if you're making $1 million or more, and you can save $100,000 or more on your taxes. Thank you so much, and till the next time.